Hello, everybody. Ed Yardeni here. Thanks for joining me today. It's October 23rd, Monday. Lots to talk about, certainly, including the weather. The weather's been just fabulous here in Long Island. It's been bright and sunny and nice fall weather. We haven't really seen here in Long Island the leaves turn just yet, but they're about to. So it should be quite a pretty sight over here. Not so pretty is what's going on in the financial markets these days. And of course, even uglier is what's going on in the geopolitical realm. We've got a horrible war still going on between Russia and Ukraine. We have a horrible war with a emphasis on horror in the Middle East. And overall, the markets have taken all this remarkably well. As we've discussed before, there is this attitude in the financial markets, particularly the stock market, that Middle East crises occur on a regular basis and that they eventually pass, and that maybe they don't take that long to pass. But you might recall that in previous conflicts between Israel and Hamas, or even Hezbollah, the UN met, and there was a lot of pressure put on all sides to come to a ceasefire. I don't hear about any meeting over at the UN to put any pressure on either side for a ceasefire. There's obviously some discussion going on about doing a ceasefire, but it's just not something that's being considered here. There's something going on with this phone here. Okay, it's probably one of those robocalls. The situation in the Middle East is just downright ugly. And as a matter of fact, in the morning briefing, we've raised the recession odds from 30% to 35% to a large extent because of the deteriorating situation in the Middle East, particularly the fact that an American battleship going down the Suez Canal spent 9 hours shooting down 4 cruise missiles launched from Yemen by the Iranian proxies that operate in Yemen. And then if the battleship retaliated by sending some cruise missiles to blow up the radar facilities that I guess they felt were close to where the vicinity of where these missiles came from. Also, there was a bunch of drones that were heading up north, clearly aimed at Israel. And so the fact that America's already involved in defending Israel from these kind of attacks is certainly an escalation of the regional war. That doesn't mean it has to keep escalating, and that maybe all sides will come to realize that proceeding on this path is going to be just a horrible death and destruction situation for all concerned. So I'm not ruling out that things will calm down. The Israelis certainly seem as though they are still intent on going into Gaza, despite the fact that I'm sure some of the Western powers have been telling Israel that the consequences of that could be pretty ugly and it could bring in Hezbollah, but they're clearly committed to dealing with Hamas once and for all. So as a result of that, I feel that the geopolitical situation isn't as likely to be resolved as quickly as it was in the past in the Middle East. Unfortunately, the Ukraine situation is turning out to be a very long war, and there's no end in sight to it. And somehow the world has learned to live with that situation. I don't know if the world can put up with 2 wars. And I guess once you think about these potential disaster scenarios, it's easy to come up with this possibility that the Chinese mainland government would see this as an opportunity to actually invade or at least strangle Taiwan with a blockade, figuring that the United States has got its hands full with supporting Ukraine and supporting Israel, at least militarily. So I'll feel better when I think we'll all feel better about these situations calming down. Right now, they're not calming down, and so I raised the odds of from 30% to 35% of a recession. Obviously, that has an impact on my thinking about the stock market. I'm thinking that we probably are going to continue to maybe hold on to this 200-day moving average, but it's hard to see a lot of upside when you have this kind of geopolitical risk. And of course, if the situation deteriorates materially, it wouldn't be much to breach to take out the 200-day moving average. So I think in the next few weeks, we need to be cautious about how things are unfolding. On top of all that, we've got a partisanship issue in the House, and I'm not talking about the Democrats versus the Republicans. We've had that issue for a long time. It's the Republicans themselves that are partisan and kind of are at each other's throats. And as a result, we are leadership-less in the House, and that's just paralyzing the government's ability to do anything, especially to respond to the situations in Ukraine and Israel. So that doesn't help matters at all. That it increases the odds that there will be a government shutdown sometime in November. So it's a lot of moving parts here. When things are looking this troublesome is usually when the brave step up and do some buying. But I find myself actually in sync with Bill Ackman. Bill Ackman, I guess, is on X announcing that he's taken his short position in the bond market and covered it, figuring that saying basically the world's just too dangerous to be short treasury bonds here, and that makes sense to me. The word danger clearly is popping up in more and more people's description of the current situation. Jamie Dimon earlier this month in his release of the bank's earnings statement said this is the most dangerous global environment he's seen in decades, and he was directly referring to the two wars now in the Ukraine and now in the Middle East. So I think that the bonds may very well hold their 5% level here. That's the highest we've had since before the great financial crisis. I don't think we're going to go up to 5.5%, 6%, 7%. But I can't dismiss that possibility, given that we've got a paralyzed government, and the bond vigilantes have made it pretty clear that they're not happy about any of it, and they're certainly not happy about the deficits and the debt. And they've pushed the bond yield up to 5% here. That may be enough to slow things down and create some problems in the financial system that get the politicians to recognize they've got to do something about the deficit, but not very likely to occur as given what we know today. In terms of the stock market's year-end performance, I still think there's a possibility here for a year-end rally. I'm feeling obviously a lot less confident about that and about getting to 4,600. But if we build up enough things to get negative about, and some of them start to turn less negative or positive, clearly the market could do better. I'm still bullish about the long-term outlook for the market, still using 5,400 by the end of next year. Between now and then, I'm presuming that some of maybe not the Ukraine war, but the Middle East war will have been resolved, hopefully in not a much more horrific fashion than we've seen so far. And meanwhile, the economy is looking pretty good. Maybe it's slowing down. That's what Ackman is concerned about, in addition to the dangers of the geopolitical situation. But the earnings picture looks pretty good. Third quarter earnings are going to come in better than expected, probably a record high for earnings. Consumers are likely to continue to spend because the labor market's likely to continue to create jobs. Well, with that, let's have a look at some of the charts that are relevant to this discussion, particularly with regards to the bond market and the economy. So let's go to the videotape here. Let's open up the charts. And I presume you're all hearing me well and that you're all seeing me well. So because I haven't seen anybody complaining about audio or video, so that's good to know. I always manage to screw something up when I do these things, but so far so good, right? So look, one of the things that's happening on the AV, all good. Thank you, Jim. One of the things that I pointed out to you last week is that we are working on transferring our charts from an in-house system to an off-the-shelf system, and we're doing it for all sorts of reasons. But one of them, I think, is they look better. So any comments you have on them will be appreciated. And right now, you're going to see sort of a combination of the old charts and the new charts, not in any one particular publication, but in a few of our publications. But this is the new improved charts. This is the 10-year. Let me make it a little bit bigger. Again, if you have any problems, just send me a message and I'll address it. But I think this should be a good size. So here we got the 10-year U.S. Treasury bond yield, and it's been a real debacle in the bond market. I guess with the benefit of hindsight, nobody can dispute that the U.S. has been in a big bubble in the bond market. Clearly, that bubble was inflated directly by the central bank, by the Fed, and not just by bringing interest rates down to historic lows of close to zero in the Fed funds rate, but also with quantitative easing. So we got down to 0.5% on the bond yield at this point. And of course, some of that wasn't just the Fed obviously provided a tremendous amount of liquidity in response to the great virus crisis. But ever since the great financial crisis, the Fed's been obsessed with deflation, worrying that inflation was too low and trying to get inflation back up to 2%. Those were the good old days, but they're over, sadly. And in a matter of 3 years or so, we've completely reversed the bull market that we've had since prior to the great financial crisis. If we took a chart all the way back to the 80s, the bull market actually started in the early 80s. But we did see the 10-year bond yield basically finding some support here at 5%. So it didn't really breach that to the upside much. And meanwhile, it did come down below that. So roughly speaking, I'd say we were in a 4 to 5% range before the great financial crisis to the great virus crisis. I call this period the new abnormal, not the new normal. And this is the old normal. And I think we're back to the old normal, where there's fears we'll go to 6, 7%. Again, I can't completely rule those out, given the fact that the bond vigilantes are back and concerned about what they're seeing in the profligacy of fiscal policy. But I suspect this level will hold. When you have bond vigilantes like Bill Ackman saying, you know what, we made a lot of money on the short side. Maybe it's time to cover. The world's a dangerous place. The economy may be slowing down. I think that's worth considering in terms of its impact on at least stopping for a while this surge in the bond yield. I'm not expecting that it's going to be taking a big dive here anytime soon. Perhaps a worsening of the situation in the geopolitical realm will create even a greater flight to safety than we've seen the past couple of days, which hasn't really been all that much in the bond market. But that's something to consider as a possibility. But 5% relative to what we think is an inflation rate that's already 2%, excluding shelter. CPI excluding shelter is 2%. CPI excluding food, energy, and shelter is 2%. So we're just waiting for shelter inflation to continue to moderate, which we think it will. I just got an email from somebody who seems fairly informed saying that I should have a closer look at that Zillow index, that maybe it's exaggerating just how much rent inflation is coming down, that anecdotally there's still evidence that landlords are able to raise rents at something close to 10%. So I'll certainly look at that. I'm always interested in the contrary opinions, but I'm of the I guess it's actually fairly contrary that inflation is going to be coming down to 2%, but it's already there. Just need to get the shelter inflation rate down. So that should be a positive for the stock market, unless it's mostly occurs because suddenly there's a perception the economy is slowing down because consumers are slamming on the brakes. But I don't see that as a real serious risk right now. The big risk in the bond market has been the excessive deficits that we're running through the fiscal year ended September. We're at $1.7 trillion. There's some accounting issues with regards to student loans. Without that, the deficit would have been $2 trillion. This is an unprecedented deficit in an economy that's growing, an economy that's going through a virus crisis or a great financial crisis. Yeah, we could have that kind of deficit, but the economy is doing well. And to have this kind of deficit is unprecedented and very disturbing to the bond vigilantes. So here we can see that the deficit concerns are justified. The debt concerns are justified. We've quadrupled the amount of publicly held debt. And I'm focusing here on public debt held by the public. And this would be excluding the intra-government holdings of debt. And you can see that that's basically gone up from 5 trillion back at the great financial crisis to over 25 trillion, 5 trillion to 25 trillion. So it's quadrupled in just a matter of a few years. Again, justified by the politicians, by the crises. I never let a good crisis go by without taking advantage of it is the motto of politicians. And so they're definitely taking advantage of the great financial crisis, the great virus crisis, to pump in a tremendous amount of liquidity, a tremendous amount of debt into the system. Keep in mind that the government's debt is somebody's assets. I mean, these things are being purchased. The question is whether 5% is a high enough rate to do the trick. We think it is. But keep in mind that people are buying this debt, which means that wealth is quadrupled. The amount of government debt held as wealth has quadrupled over this period. So if you want to put a positive spin on it or offset that with a positive spin, think about that for a while. Here's the deficit on an inverted scale, 1.7 trillion, more like $2 trillion without the accounting gimmickry. This is on a 12-month basis. This is outlays on a 12-month basis, receipts on a 12-month basis. The receipts, obviously are very cyclical, but they look like they're kind of trending, coming down back to their upward trend. So that's where some of the weakness lies. And the outlays is just, this isn't even Bidenomics yet. This is really more Social Security outlays being boosted by the inflation, the fact that they're tied to inflation. And here, of course, is the other big part of it, the fastest growing part of the government debt. The fastest growing part of the government debt is net interest paid. And as you can see, that's basically doubled in a little over a year. And when you take the amount of public debt that we looked at before and use the net interest paid to calculate the average interest being paid by the government, the answer is 2.5%. And the 2 years at 5%. So over the next 12 months, this is going to continue to soar and continue to be a problem on the deficit side. Meanwhile, on the demand side, that was the supply of securities. On the demand side, the Fed, as we all know, has been tightening not just by raising interest rates, but also with quantitative tightening. I think they've overdone it. I think they should have just focused on the Fed funds rate and worried about QT later. But they thought they could do it. And obviously this has had an impact on pushing the bond yields higher because on average, they've been selling the treasuries at a rate of $50 billion per month. So that's like $600 billion at an annual rate. So in effect, they've increased the consolidated deficit of the government when you consolidate the Treasury and the Fed by $600 billion. This is just mortgage-backed securities, which has also been pared down. Interestingly, the Fed has been aware that they're destabilizing the financial markets, particularly the bond market, with their QT. And maybe that's why they actually haven't sold the Treasury securities over 10 years. You can see that they're actually up a little bit. But everybody's looking at the total decline in treasuries, and that's obviously been a contributor to the supply of treasuries when you consolidate the Treasury and the Fed. I used to call them T-Fed, and when thinking about these things. So how about the commercial banks? The commercial banks have also been cutting back on their securities holdings. And that's, I think, coincident with quantitative tightening. When the Fed is buying treasuries, that tends to increase the deposits in the commercial banking system. When they're not buying and they're letting the treasuries roll off, that puts downward pressure on deposits. So you can see that the commercial banks have been dealing with that weakness in their deposits by letting their securities mature and using those to offset the weakness in deposits. And you can see that this all in Figure 9. The blue line is, let's see, there's the deposits, and you can see they've been edging downwards here, maybe coming back to their trend. Meanwhile, loans and leases have been flattening out. This is the securities again. Total securities have been coming down, and this is the borrowings. But the main point is that the Fed and the Treasury and the commercial banks have been cutting back on their holdings. So the good news is, as Jerome Powell said at his interview last week, is the notion that foreigners are selling U.S. Treasuries is not really quite accurate. The Treasury does put together monthly data, the TICS data, the Treasury International Capital, on monthly flows into our capital markets. And as you can see here, this is the data on U.S. Treasury notes and bonds on a 12-month basis. And the private foreigners have bought almost $600 billion over the past 12 months. All the talk about the officials selling is actually true. They've been selling, but at least over the past year or so, that's been more than offset by foreign buying. And there's monthly data. So I'm able to look at the August number and the 3 months, and they show that the private foreigners are still actually buying in our bond market. It's notes and bonds. It's not treasury bills. So I think that's an important distinction. Meanwhile, what about individual investors? Well, they're buying some treasury securities through the huge inflows into money market mutual funds. There's a tremendous amount of liquidity. Obviously, people are taking advantage of these interest rates to stay out of trouble in the stock and bond markets and just put their money in money market funds and earn that kind of yield. But some of that is treasuries. Keep in mind that, again, not only is all that government debt somebody's wealth, but all that interest that the government's paying is somebody's net interest. The net interest of consumers in personal income rose to an all-time record high during August. So that's something to kind of offset the concerns about the debt and interest costs, just to sleep a little bit better at night. But obviously, these are still major issues. Meanwhile, what about the economy? What about the consumer? Well, I kind of did some more work updating the whole consumer idea that retiring baby boomers are going out to restaurants more often. No point in cooking for just 2 people at home. They are traveling more, and they are seeing healthcare providers on a more regular basis. And so they're creating a lot of demand in the service sectors that are most labor intensive. And so it's somewhat circular reasoning, but it's logical reasoning. And that is, as more and more people are using or buying these kind of services that are labor intensive, we see lots of job openings in those areas. And as those jobs get filled, that creates more consumers with more purchasing power to keep the economy growing. Doesn't go on forever, but it's certainly, I think, a very good explanation for what's been going on over the past couple of years in the face of lots of forecasters who've been saying the consumer is going to retrench. And some of them have been saying they should be retrenching right now because they should be running out of excess savings. Maybe some of them are saying, well, it hasn't quite happened yet, but it's going to happen any month now. I just want to give you sort of a countervailing argument on that. Meanwhile, it looks like we may be seeing some shift pivoting back from just this whole hog move toward services back to merchandise. And so we're seeing, at least in current dollars, that retail sales of merchandise is going up. And that, by the way, includes food services. But even if you do core retail sales, which excludes building materials and food services, you can see that we're at a record high. That's the blue one, I should say. And that's why we've seen personal consumption expenditures moving higher. This personal consumption expenditures of goods, I should point out. So they all look pretty good. Just a quick run through here. We got food retail sales, all-time record high, particularly of food services and drinking places, all-time record high. So we're seeing that food services and drinking places, red line, accommodation, this is payroll employment, is almost at a record high. Probably would be a record high if all those 1 million job openings would be filled. So there's a shortage of workers there. Healthcare, same story, all-time record high in consumption of healthcare services, and all-time record high in healthcare employment. So that's it. Let me stop sharing here. Let me take a couple of your questions here. Let's see, Jake, how should we think about the level of debt of different companies, large and small, and its impact on their performance next year? Well, interesting question you ask, because I think one of the reasons that the mega cap 8 stocks continue to outperform the market, and that's got a lot of people concerned about the breadth of the market, which is a concern. It would be much better to see the market broaden out. I think it still could, but right now we really have to deal with the downside risks than the upside potential. But by the way, I view these sell-offs as buying opportunities, since I remain long-term bullish, and the focus would be on energy, financials, and IT. So any deal you get there, I think, would be worth taking. But one of the reasons that IT companies, particularly the bigger IT companies, and particularly the mega cap 8 companies that are not only IT, some of them are consumer discretionary, some of them are communication services, but they don't get impacted as much by rising interest rates. When they do a lot of their borrowing, they do it for buyouts. That's not something they have to do. It's not something that necessarily affects their operating situation. Whereas maybe some of the value stocks tend to be more dependent on debt, and therefore are more sensitive to rising interest rates. So I would say that in portfolios, it'd probably be a wise thing to move towards companies that aren't as impacted by rising interest rates. But I'm telling you something you all know already. And maybe that's one of the reasons some of the mid caps, or a lot of the mid caps, have underperformed. Maybe they are more affected by rising interest rates, and rising interest rates obviously increase concerns about a potential for a recession, and these stocks don't do well when there's those kind of concerns. Okay, a question here from Eva. Hi, Eva. Are boomers liquidating their stock portfolio savings to support that lifestyle you were talking about? Is this a headwind for the next many years? Hey, that's a very good question. And I don't know that. I know that the boomers have $77 trillion in net worth. That's about half the total net worth of the entire household sector. I know that a lot of them probably have quite a bit of interest income and dividend income. So that may be a source of their spending. But some of them may very well be selling equities and bonds. But I would think that would be kind of the last thing they would do, to the extent that the equities and bonds are sources of dividend income and interest income. So I would say at this point, they're probably living off the interest income and dividend income rather than selling stocks and bonds. I'm sure a lot of them wish they had sold their bonds instead of buying a lot. A lot of people bought a tremendous amount of bonds. I think we had record bond buying in the mutual funds and ETFs for bonds back in 2020 and 2021. And then, of course, everything kind of got blown away there. But at least you can hold them to maturity without taking the losses. See what else we have here. Brian, given the recent conflicts and inflation lowering, it seems to me that the Fed is done raising. Do you expect these conflicts turning the Fed to dovish sooner than anticipated? Well, the Fed seems to have this attitude that they want to be as tough on inflation as they can be, because I think they still are bruised by the fact that they were behind the curve on inflation in late 2021 and early 22. And then they realized they had a significant problem. They concluded that it wasn't persistent, that it wasn't transitory, that it was persistent, and so they went, they stepped on the monetary brakes and raised interest rates by over 500 basis points. I think they're done. I think they should be done. It wasn't. We didn't get a hint of that, very much of a hint of that, in Powell's interview last week. Quite the opposite. Powell seemed to focus more on, hey, the economy's strong, and if it remains as strong, above trend, it might be a problem for inflation, in which case we will have to consider raising interest rates. So they're still talking tough, but I'm thinking that with all that's going on here with the bond yield, Goldman came out with an estimate that the increase in bond yield is equivalent to an 80 basis point increase in the Fed funds rate. My estimate is that it's equivalent to a 100 basis point increase in the funds rate. I mean, I think the bond yield is more important than the Fed funds rate for most borrowers. And if that's the case, then we've seen the bond market, the bond vigilantes, if you will, tighten quite a bit. And it's not because they're upset about what the Fed's doing. I think they're fairly pleased that the Fed's gotten its act together on fighting inflation. I think their main concern is the supply of bonds, which is a reflection of fiscal excess. Take one more here. Keep this thing relatively on schedule. That note of the other side of the, oh, okay. So on the note that the other side of debt is an asset, given we see extended leverage pretty much all over the U.S. government, consumer and corporates in Europe, China, and Japan, I have a hard time seeing emerging and frontier markets are the ones funding the leverage in developing markets. So who is? Well, so you're saying if we got all this debt, who's actually buying the debt? Well, I think the data shows that foreigners are still buying the debt. I suspect that the household sector, we don't have much monthly or high frequency data there, but I think that's happening. And institutional investors, like pension funds, view current rates as pretty good in terms of being able to meet their fiduciary obligations. So I think there are buyers, and it's all over the world. People who are certainly being attracted to 4 to 5% bond yields. Well, on that note, let me wish you a good week. Let's hope things calm down a little bit. Wishful thinking is always a good thing to have, I think. But look, the economy is doing well. I think inflation is continuing to moderate. I'm hoping the Middle East situation will be contained, and we don't get the U.S. being forced to shoot down a lot more missiles aimed at Israel. But we'll stay nimble here and try to stay as informed as possible and discuss these things with you both in writing and in these calls. So see you next week.